Okay, so today on this really special episode of And Taxes, I don't have a guest, so I'm cheering to you, my viewers. I took a creative step back for a few months. I just want to let the family know what we've been up to. Um, the project is still very much alive. And Taxes for me is something that I am working on and deciding on how I want to build it as a brand, as a lifestyle. I've been working and networking with a lot of people in the background, so I have some great stuff coming for everyone to watch. And thank you, of course, for those of you that supported me. But a lot has happened this summer. I also am going to be honest with you guys, and I have enjoyed my summer. If you kind of see my tan, I've been, a week in Mexico, a week in Curacao. I did Vegas for work and pleasure. A little weekend trip with Miami with my nieces, and we had a lot of fun. So I have been enjoying my summer. I have been enjoying my daughter. I am gonna say though that something major happened July 4th. Besides fireworks, and one of the biggest changes in the tax code is here again. Um, One of the things that I always like to talk about when we talk politics is that no matter who's in office, red or blue, we're always going to see that new leadership comes with a change in the tax code. And one of the things that happened the first time around that President Trump won was the fact that he brought in the Tax Cuts and Jobs Act of 2018, which completely changed the game. I had associates from my association that I belong to professionally that were already in their retirement age saying, you know what, I'm retiring. We literally just changed the way we do taxes, and it was the biggest change in tax code in a long time, and that's when we had the limitation on salt. And I'm sorry in advance because I'm going to talk in my nerdy tax language today, um, which is not what you guys are used to because this is how I speak to my coworkers, my colleagues, my employees, because we speak in acronyms of what we're describing. But um, the state and local income tax limitation of the $10,000 that happened way back then in 2018 affected a lot of my clients. I'll give you an example. In 2017, when we were introduced to the Tax Cuts and Jobs Act, it brought the biggest change to tax code history. We lost work related deductions. So back then, we used to have a conversation with our tax people when we were doing taxes, and it's actually something early in my career. I remember a lot of people, especially because I grew up in a very diverse neighborhood, and the office that I worked at it was a very diverse neighborhood. So you would have even you know the Latino community coming in, and they're saying, I want to do the long form. And we're like, the long form, the short form, the long form? What are you talking about? Well, they're talking about itemized deductions. And that was before when people were allowed to say if they had work related expenses on their W 2 salary jobs, they would write off things that they would spend and were not reimbursed by their employer. So, one of the biggest things that happened with tax reform that year when Trump was president the first time around was the elimination of that. And then we had a really big increase to the standard deduction. We eliminated exemptions. Mind you, New York State decoupled from all of this. And we were introduced to the limitation of SALT. SALT stands for state and local income taxes. And I'll give you an example of how this affected somebody. If I have a client that is a NYPD police officer and they are well in their years of service, let's say their salary should be anywhere between 130 maybe to 160 with overtime. And we know during COVID they had a lot of overtime. And then, contracts, and they get retro payments. They their state income tax that gets deducted out of their paycheck to New York State could easily have been $6,000. And then as employees of New York City, they have to pay the local tax in New York City. That's at least another $3,000. So let's say roughly $9,000 is what they were paying a year in their New York State and their New York City income tax out of their paycheck. That used to be a write-off. That is still a write-off that exists on the federal tax return. Now let's say they own a house. They own a house. If they own a house in Westchester, you're talking about property taxes being anywhere between $14,000 to $25,000 a year. My own are $25,000, and I live in Dutchess County. And then, or if they're in Orange County, they could be at 9,000. They could be, 12,000. They could be 15,000, depending on the lane. I've been penalized for having an in-ground pool, hence why I pay $10,000 a month, a year more than my neighbors. But where am I getting at? This one particular example, this one employee had a write-off of at least $20,000, and tax reform of 2017 capped it at the first 10,000. Why am I here today by myself? I'm going to talk to you about what happened July 4th. July 4th, our president signed the One Big Beautiful Bill Act of 2025. The One Big Beautiful Sexier Than Ever bill. And it brought a lot of changes. So, I'm not surprised. The first time around, I'm one of believing in the lesser of two evils. Personally, I don't vote and I have an opinion. My opinion is that if you don't vote, you don't have an opinion. So I can't give an opinion. But when he won the first time around, I just kept telling myself, all right, it is what it is. Let's just pray that he doesn't touch the tax code. That's the only concern I had. And then, of course, not only he touched it, but he revamped it. All right, fine, we moved on from it. Professionals, we had to learn all over again how to do taxes. And it's fine. As a public speaker, as an educator, as an accountant, I'm perfect. This makes me relevant. My competition is exiting the building because they don't want to deal with learning their jobs all over again. You know what I mean? I'm sorry. I love my old people, but old people don't like change. And that's the part of the game, though. We evolve. There's electric cars that drive themselves now. Like, we are in 2025. Things are not the same that they were, 20 years ago. So yeah, the tax code is going to change. It is what it is. So we have a new bill. It's here. So I wanted to take today and talk about how this is going to affect us moving forward. Because there's a lot of stuff in this bill, and there's a lot of misconception. You know what I mean? Again, the fact that he won the second time around, was I surprised? No, because I'm sorry, Democrats, you guys had a shitty candidate. Like, I'm just going to say it. It is what it is. There's other people we could have put against him, and no, I'm not even going to go there. Again, I don't have an opinion because I don't vote. That's a personal thing. That's just my choice. I still have rights. Maybe till Monday. But one of the things I want to make valid with this One Big Beautiful Bill is that it made the definition of a social security number relevant. This campaign upon this election was very immigration based. So he brought it to the tax code. There is very specific rules now that's saying that this only applies to you if you have a valid social security number. And let me talk about that for a second, because you can meet somebody, or you could be a person with a social security number that is in an immigration process, and your social security card reads valid but not for employment, or valid for employment only, which means you're allowed to work, which is why we gave you a social security card, but you don't have rights. You're not a legal resident of this country yet. And that clarification was made with this bill, saying any credits that we're bringing in is going to apply to people that are valid social security number holders. So even though I always say, and people don't realize actually how much immigration and income tax go hand in hand. The tax return is an interesting tool, and one of the things why I love what I do is because I tell people it's not about getting a refund check once a year. This document determines whether you can buy a house. This document determines whether your kids go to college and how much you have to come out of pocket. This document decides about your health insurance. This document is used for many things. So one of the things that we have to realize what's happening here is that whatever the agenda of the Republican Party had, we're pushing it through. I'll make an example, and I promised myself that I wasn't going to go off topic too much, but I have a creative flow. I have to keep going. So the campaigns were like, well, we're going to promise child tax credit because I was going to save children until the end because kids are ghetto, right, Kaylee? So we were going to say this at the end, but I'm in a flow. Right now, we had Blue saying we're going to give you $6,000 of child tax credit. So, you know, all my baby mamas out there were so excited. Oh my God, I'm going to get $6,000 on my taxes next year. All the baby daddies were getting ready to figure out how they're going to make up with baby mamas so they can have split that 6,000. But then Red said, well, we're going to give you 5,000. The One Big Beautiful Bill gave us a $200 increase to child tax credit. So previously, child tax credit, which is the credit that you get when your child is age 0, born in the United States, age 0 to age 17. Now, I have this argument with my clients constantly. Everybody wants to fight about why is it that my child does not get child tax credit once they turn 17. Well, it's because age 0 counts as year 1. So by the time they're 16, it's the 17th year you've claimed the credit for the child. So 17 really means 18, which means 17, which is unfortunate because it's usually when they're a senior in college. You have probably the most expenses with this child. But now they dropped from a $2,000 tax credit to a $500 tax credit. Now, we were promised during the campaign that this was going to be either $5,000 if Red won or $6,000 if Blue won. We got $200. Child tax credit is now $200. So baby mamas and baby daddies, if you guys want to fight over $200, go for it because that's all we got. That's all we got with the One Big Beautiful, Sexier Than Ever, Fancier, Parks Itself Act of 2025. And we have to realize how this is going to affect us because, again, let's be real, we're all living in different, you know, my mom has a saying in Spanish, cada cabeza es un mundo, which means every mind is its own world, right? We all live in our own worlds. And what's happening with me and happening with you, it's not the same thing. When tax reform happened, when Tax Cuts and Jobs Act came in, I was very upset because I saw the change in my clients' returns. Clients that were receiving $8,000 in a refund were getting $2,000 in a refund now. Clients that were never owing the government money were now owing the government money. So it was upsetting for me as a professional, but as a business owner, it actually did good by me. Tax Cuts and Jobs Act introduced something called QBI, the Qualified Business Income Deduction, which basically said if I met the requirements, it would shave off 20% of any profits of any businesses that I owned. So if I have a business and, for example, currently I'm sitting right now in my investment property. Today I'm coming to you from Ted McCassin, owned by Ted McCassin LLC, which is a partnership owned by my husband and I. And we have an Airbnb on the first floor, and we have some rental units, and we have some parking garage unit spaces, and I'm now doubling it up as content creation for today. And this could profit $100,000 a year, and QBI will give me 20% off, and I'm only paying taxes on $80,000. Essentially, again, there's a lot more complexity to it, but I'm just putting it out there to just make you guys understand that what works for one person doesn't mean that it's going to work for everybody. I can be upset the fact that my clients are not that the laws are not helping them with where they want to be, and I can agree with them, but at the same time I can't complain when I know that my financials look better under this administration. So it is what it is at the end of the day. People in power do what people have to do, and the lawmakers, and again, this is the part where I'm supposed to say go vote and go again, you do as I say, never as I do type of deal. So I want to dive into the this bill, because this bill came with a lot of talk, right? It stemmed from the campaign. It stemmed from we're not going to tax tips. We're not going to tax overtime. So now everyone's thinking, "Oh my god, yeah. Oh my god, I know people that have shared stories with me of people that they know, of things that like coworkers and friends and family members have said." So now it's like, "Okay, let's bring it to light." So, let's talk about no tax on tips. No tax on tips, everyone in the service industry is thinking, "Okay, well, that's my president. He's going to make sure that I don't pay taxes on my tips." All right, let's dissect it. If you work in the service industry and your tips are reported on your payroll, on your paycheck, it's still going to get taxed. Weekly, bi-weekly, however you receive your paycheck, it's still going to be taxed. What he delivered was no income tax on tips. You're still paying Daddy FICA. You still have to pay into Social Security, which might not be there for you by the time that you get to 65, you 24-year-old that's working at Olive Garden. You're not going to get there because, his plan is to dilute it. So let's hope that we're probably going to have to retire at 75 to get Social Security, but you're paying into the pool. That's not changing. You're paying into Medicare. My mother is on Medicare only. My mother gets nothing from Medicare. Her medicine has been more expensive now than when she was an employee at Costco. More expensive now. But all her life, she's paid Medicare tax. She's paid into the pool. So you're still paying Daddy FICA. That's not changing. What's happening is that we're going to the tax return. Now you're coming to me to your taxes. And we have a new form. And that new form on the tax return is called Schedule 1A. So the first time he fucked up the tax code, he gave us schedules. Now we have Schedule 1, 2, and 3. And some of these represent line items on the 1040. Now I know you people that are not in my industry are saying, "Joey, what the hell are you talking about?" I'm going to give you a quick lesson on what's called above the line and below the line deduction. Above the line deduction means you make $100,000 a year. You qualify for an above the line deduction of $1,000. You're taxed at $99,000 a year. An itemized deduction helps you reduce how much taxes you pay on the $100,000. It's not a tip for tax. It's not a math equation. So above the line means that 1 plus 1 equals 2 and 2 minus 1 equals 1. For example, medical expenses. There's so many rules with medical expenses, and I've talked about this before in other videos. I've talked about how if Botox is used to treat migraines, then it's a write-off, but if Botox was used because you want to look 10 years younger, then it's not a write-off. That's not a 2 minus 1 equals 1. That is something that we calculate in hopes to reduce how much your tax calculation will be. But your income has been already stated. So we're going to talk about above the line a lot today, and I'm hoping that this video will bring some clarity as to what we are getting. Because everybody's thinking, I'm not going to pay any tax on tips, but you are. You're still going to get taxed on it. And here's the rules to this. Remember that Social Security number thing I said earlier? If you are not an actual legal resident of the United States or a citizen, you cannot participate in this deduction. So, I work at Applebee's. My tip income, My annual salary as a waiter is 45,000 a year, of which $6,000 is the reported tip. Now, I started End Taxes because I wanted a platform that I can talk and be by myself. I am not representing any brand but my opinion and how I feel. And I'm going to be honest with you. You all lie and don't report all of your tips when you work in the service industry. It's just the truth. It's okay. I would do the same thing if I was a waiter. I used to be a waiter. So yes, I used to be a bartender. So I exactly know how this works. So the deduction qualifies for what we report. You can't say, "Oh, I got $10,000 in cash tips." But if you're failing to report it as income throughout the year and paying the FICA taxes on it, you cannot get the deduction that's coming in with this new law. No, sir. So, and I know what you guys do. I love you guys down, my service industry people. Again, I used to be in the service industry. I am dying to go back into the service industry because I really did enjoy it. My husband just won't allow me. But I really am being truthful and honest when I'm saying that it's going to be based on whatever you put through the credit cards, because you guys have no choice but to report those. So the credit card tips are going to be considered non-deductible. So let's go back to my example. 45,000 a year, 5,000 of that was tips. So that means before I start calculating how much taxes you should have paid to the government in 2025, I'm going to remove the $5,000. Now there's income limitations to this. There's a lot more that goes in, more than I can fit into one video. So it's the reason why you hire someone that knows these laws, right? And that's the T. Because it's not something that you guys, you know, everybody thought that as of July 4th, you know, Red Lobster was going to stop just taxing your tips. No, sir. No, ma'am. You have to still pay them through payroll. The payroll processors now have a job to do. The W-2s have to now state how much of your income is tips. Because based on that, that's how we, the tax professionals, are going to remove it from the calculation, resulting in a slightly higher refund. Okay? Now let's get into overtime. This is something true to my heart because I pay a lot of overtime. And anybody that's a Bob's Burger fan, I identify as Bob. I literally look at my employees every day and say, "You're terrible, you're horrible, I love you, but you're just terrible at what you do." So when I have to pay overtime, I'm bleeding internally. I probably give myself a hemorrhoid. That's how much it exhausts me when I know that I'm paying somebody overtime and they're not being competent at their job. So it's something that as an employer is the worst thing that I can think of in my life. Regardless, it's a choice because as an employer, myself in the industry that I am and being in the trenches with my staff, I do believe that you should get compensated if you are putting in extra time. There's companies out there, okay? There's corporate companies out there that says, "Oh, you meet the salary requirement. I pay you more than $46,000 a year. I don't have to give you overtime, but I'm going to obligate you." I'm not as toxic as you think. I'm toxic in other ways. Like I'll throw a printer at you, but I will not compensate you for your time. Anyway, I pay overtime. So, no tax on overtime. I have NYPD officers that get overtime. Let me not get started with Yonkers firefighter overtime. Literally, they're getting like $136 an hour to like get a cat out of a tree. I love you guys down, but let's be honest, I know you guys personally. You guys are at the firehouse playing video games, watching a movie. Again, tax dollars. I'm not mad at you. If I was physically fit and I could pass the test, I would be a Yonkers firefighter. 100%. No shame. And don't get me wrong. When you guys are in an emergency, yes, you're putting your lives at risk, and I completely agree with it. I'm just stating facts. Overtime is not just somebody at Walmart doing Black Friday. Overtime happens in NYPD. It happens for firefighters, city officials. It happens all over the place. So when this came out on the campaign trail, I'm not going to tax overtime. Everyone's like, what's the T? So this is how it's going to be calculated. It's going to be an above the line deduction. Remember, above the line means that 2 minus 1 equals 1. Okay? So, if my individual makes 100 grand a year, but of that 100 grand, $10,000 is overtime. What everyone thought was going to happen was that, oh, that means I'm only going to be taxed on 90 because there's no tax on overtime. Wrong. That's not what's happening. That's not what's happening. This is what's happening. And it's even more fucked up than I originally thought. I knew that it was going to be a tax return item because this administration, like it did 8 years ago, loves to torture the tax community. He hates the IRS. So I knew this was going to be, it was going to fall on our hands. It was going to be the tax professionals' problem. It wasn't going to be payroll's problem. So, like I mentioned earlier with the tips, this is something that happens at the tax return table. So when you come to see me, that's when we do the calculation. You will still get taxed on your overtime, as you guys already know, because today is September 28th. This law was signed July 4th, which means what? They're still taxing your overtime. It's not a secret. You know that already because the taxes haven't stopped. You're getting income tax, state income tax, you're getting FICA pulled out of that overtime rate. So now they're going to throw it on us. We're going to have to calculate it. Payroll has to tell us the amount. You know, the W-2 will have to reflect how much of your box one salary is going to be OT. But then here's the kicker. And here's where I got upset because I was like, you know what? Fine. And I remember walking up and down the halls at the office and saying to my employees, you guys are good. You guys are going to be in a great position next year because I know at least 5 to 10% of your salaries is OT. So you guys are going to be great next year. You're going to be golden. It's only the time and a half that's going to be excluded. Now, let me break it down Barney style. If I make $20 an hour and I work overtime, 1 hour of overtime, it gets paid at $30 an hour. Time and a half. Half of your rate is the plus up that you get paid for that hour. So you get your $20 an hour plus half of what your rate is normally, which in this example, it's $10. So $30 an hour. What we all thought was going to happen was that the exclusion of the income was going to be the $30 that hour, that $130 hour. It's not. It's going to be the $10. It's going to be the half. That's the only amount that's getting excluded. So fair warning for any of my clients that are watching this, don't give me no shit when you walk into my office. This is what is happening. You're only getting excluded the plus up that you paid. So you worked 50 hours of overtime and your boss didn't give you time and a half, it's not considered overtime. It is what it is. It's only on the additional amount, which really sucks in my opinion. But I didn't vote, so I don't get an opinion. That's what's happening. Here's the most ironic thing of this whole situation. A lot of these benefits that this tax, no tax on tips, no tax on overtime, it expires in 4 years. This is not permanent. This is in only 4 years, which means that if whoever comes in power after him does not extend it, it's gone. And let's not forget the immigration provision. This only is going to be relevant if you have legal status in this country. Social Security numbers got a really big enhancement in the IRS code. So they're going to be policing that, making sure that if you are here on a work visa or you're here or you're trying to get legal status and you're halfway through the process, these benefits do not qualify for you. They're very, very adamant about that. They made a big deal about it in every single update that I attended so far. The next thing I want to talk about is our senior citizens, because if you guys remember, on the campaign trail, a lot of the things that were said was that our seniors, right? Because you people are the only ones that still vote. So, seniors, how are ya? You got $6,000 off the top. That's all you get as long as your income is under $75,000. Now, if you're living on Social Security income alone, you're probably dead by now, but this doesn't pertain to you because if it's Social Security income alone, you're not filing a tax return. So thank you for your vote. The ones that actually have investment income, the ones that are retired teachers, retired police officers, people that have made moves in order for them to actually say, I need to survive when I'm over the age of 65. As long as your investments and your retirement income is not exceeding the $75,000, 150 if you're married, you get a $6,000 shave off the top. That's all you got. Social Security is still taxable. And remember, Social Security income, if it's not combined with anything else, is never taxable. The minute you have a 401k distribution, the minute you have a casino winning, the minute you have a part-time job at Walmart, we have to determine whether the income is going to make it 50% taxable, 85% taxable. We have to make that decision, or 15% taxable. We have to, some of those benefits from that same pool that you've been paying all your life in this country will make that income taxable. It's not ironic. Aren't you like paying taxes twice? Because you paid taxes through FICA all your life from 18 to 65 or whatever the hell you retired. And then now, God forbid you were smart enough and said, I have a portfolio, I invested some money, and your portfolio made money. Now you got to pay income tax not only on the investment or the 401k money or the little part-time job you have because you don't want to be bored. You also have to pay it on the Social Security income, that same tax that you paid all your life and you paid into the pool so that it was your turn. That's it. The campaign promise was we were supposed to have this income tax free. I was all for it. If this really was going to happen, I was like, oh, that would be amazing. There's so many seniors that are out there that they don't understand the concept of taxation, don't realize what's going on with their investments, and they're being led by financial planners, other accountants or CPAs, lawyers, their children. So my thing is like this would have been great for them, but all we're getting is a shave off the top of $6,000. If they're married, the income must be under 150. If they're single, it has to be under 75. Okay. Again, and it's going to be one of those items that I mentioned to you, the new form, Schedule 1A. And let's go back and remind you, above the line deduction means 2 minus 1 equals 1. So it means that it's going to come right off before we start calculating tax. Teachers! I love you guys. Love my teachers. Education is important. And one of the things that was very upsetting in 2017 was when the Tax Cuts and Job Act removed the job-related expenses, because you guys were the first people I thought about. I'm like, wow, union dues. Like I have so many teacher clients and my teachers that work in bigger school districts. I get so many stories of like, my heart couldn't, and I had to buy this kid a coat because the family just couldn't do it. Or I asked all the parents for, X amount of supplies, and obviously we did not deliver, and I had to go to Walmart or I had to go to Staples and I had to pick up. Some districts do give teachers a reimbursement. It's very small. And for the longest, there was above the line deductions of $250 per teacher. So if a teacher makes 100 grand a year, the government only gave us 250 to lower their income by $250, which really came at a tax savings of like $4. That's all we had. Recently, it was increased to $300. So now we're from $4 to $8. Okay, great. Thanks. The One Big Beautiful Sexier Than Ever bill brought an itemized deduction allowable for only teachers, but instead of calling it an itemized deduction, it's an above the line deduction. So if an educator, and it's very strict to K through 12, okay? If a K through 12 educator spent more than the $300 that we currently have in classroom supplies and work-related supplies, then we're talking about an above-the-line deduction. So let's say if one of my teachers poured $2,500 out of their pocket, then now we can take $2,500 and lower their income by that. So that's really good news. I'm very excited for that because it's not a Schedule A item. It's not a long-form item. It happens right above the line. We don't have to worry about, before, whenever someone says medical, I have to tell you, okay, well, you got to spend a certain amount of money in medical for even to count $1, and then you have to spend a certain amount of other qualified itemized deductions in order for it to lower your taxation. We don't have to worry about this. So teachers, you guys, I'm really excited for this. Um, I'm pretty sure New York State, for those of you in New York, New York State is infamous for decoupling whenever the federal does something. So they're probably going to decouple and stay to what they know. Itemized deductions for the work-related individual is already still existent, but I am currently always working on itemized deduction audits with New York State. So this is a good reminder that you guys need to have receipts for everything. So yeah, the Walmart receipt, it's not just how you paid for it, but it's also that you kept it. We live in a digital era. Scan it, take a picture of it, create a folder or an album on your cell phone so that if you do get audited, we can send these receipts. And I even told teachers now that I speak to, if it's something expensive that you bought for your classroom, like I had a teacher that justified buying a Cricut, and you know that those Cricuts have, they're expensive, right? And they have a lot of materials involved. But she's doing constant things with her class, and I said, you know what? Do me a favor. Not only save the receipt, I need you to take a picture of the Cricut in the classroom. I need to sustain that it actually exists in the classroom, and you're not starting, a T-shirt business in your basement. I need to sustain that it's in the classroom because auditors are ruthless. That's what their job is. So I'm really happy that it's happening for teachers, but I also have to warn you guys, don't sit there and expect us to just write this stuff off. You have to have an accountability of it, and you got to do the math. And I mean, if you're a teacher, you should be able to do the math. So come on, the same way you yell at your kids, your students, I'm gonna yell at you. Do your job, plain and simple. The last thing I want to talk about that's considered above the line, before I talk about any credits, any tax credits, it's going to be the deduction for car loan interest. Now, Bobby Trump got into a fight with Elon Musk. Therefore, the energy credits for buying an electric vehicle, bye bye. You had to buy an electric vehicle by September 30th of this year, which means today is September 28th. So if you're not going to watch this by September 30th, it's already too late. They gave us until September 30th to purchase any electric vehicles, to pick up any electric vehicle credit, but it's gone. The credit is completely gone. So I don't care how electric your car is, I can't give you a credit for it. So, how did he compensate? We got the car loan interest, up to $10,000 of interest that you pay for a car loan, as long as the vehicle is purchased new and EW, okay? And final assembly had to happen in the United States, which means we're going to get a list of qualified dealers and vehicles that we could use this on. So as long as final assembly is going to happen in the United States, we're going to be able to get this deduction, as long as the interest does not exceed $10,000. Now, for those of us that are purchasing new vehicles in 2025, we know that the federal interest rate is so high right now. So getting to that $10,000 number is highly, and it's going to be above the line. So again, let's say you meet the $10,000, your salary was 100,000. I'm going to be able to lower your salary to 90,000 just because you bought a new car and paid over the $10,000 of interest. So it's not bad at all. It's something to look forward to. But the electric portion of it all, it's gone. It's gone. So you Tesla lovers, my husband has an electric Hummer. I hate how expensive it is, but don't mind how comfortable it is. Um, but it's one of those things that we thought it was going to be the new wave. And get this, it's not just the cars. Oh, you solar panel salespeople that for years have lied to my clients saying that they're going to get $1 billion back in a refund because they put solar panels on their house. And then I had to explain to them the concept of what a non-refundable tax credit is and how it only works if you paid taxes throughout the year. And you guys failed to include that part. Well, Screw you, because there's no more residential energy credits. 2025 will be the last year we'll see them on the tax return. Buy solar panel, buy geothermal heat pumps, buy credit for insulation or any electrical improvements done to the home, buy for any what is the other thing that they had? I think it was a you had the heat pumps, geothermal, whatever. Any of that that's energy efficient, it's gone. 2025 will be the last year we're going to see it. Moving forward, it's exited the return. Okay? Papi Trump does not care what you did to your house. Does it? Doesn't at all. Okay? So that's very important because a lot of my clients we're doing a lot of small improvements knowing that, well, if it's a tax write-off or if it's a tax credit, let me know and I will make sure to do it. And we lost that. Moving on to my gamblers. Gambling income is my favorite thing to talk about because I'm married to a gambler. Cool story. One time we went to Vegas because I had a tax conference, and then I get picked up in a stretch limo by MGM. We were staying at MGM Grand, and then I was like, "Huh." I'm like, "That's new. We've never been picked up before by a hotel." And then we get in the limo, and then they drop us off at the Top Golf entrance of MGM. Any of you that ever been to MGM Grand, it's like going to a Six Flags ride. You're standing in line for 2 hours just to check into your room to be told that you'll get your room in 2 more hours. And they were like, no, Mr. Rodriguez, you guys are going to be going in the Top Golf. And we took an elevator all the way up. We go, and there's a woman at a desk, and there's no one there. We get checked in. We get walked to our suite. It's a 2-story room with a steam shower, which was a beautiful steam shower. I love that shower. It had a steam shower, a walk-in closet, a dining room, and a view of the Las Vegas Strip and the mountains. It was gorgeous, and I turned around and I said, "How much money did you lose at MGM?" Because they only will do this if you play a lot. And that's when I had to go into my husband's MGM account and find out how much he was actually gambling. See, as you guys know, I like to drink, and what happens when you drink? You get sleepy, so I go to bed when I'm in Vegas. He stays up. And the casino likes to pump a lot of extra oxygen on the casino floor to keep you crisp and keep you awake. Um, Me, I like to gamble to the point until I got my free alcohol, and then I go to bed. So, this provision, the One Big Beautiful Sexier Than Ever Act, brought change to gambling losses as we treat them. Currently, if you have gambling winnings, you receive what's called a W-2G. And you have to claim that as other income. So that's going to increase your tax bracket. Your taxable income is going to go up. And previously, we were able to write off as an itemized deduction. So this is not an above the line deduction. So it's not a 2 minus 1 equals 1. No. This deduction is literally going to be what's your end number of how much money you earned, and then how much of your qualified deductions can lower the calculation of what your income tax should be, which is completely different. It's not, I won $2, I spent $2, so I'm going to minus it. We do that with capital gains. How much did you buy the stock for? How much did you sell the stock for? The difference is what you pay tax on. In gambling, and IRS loves to audit this, especially on a senior citizen level. In gambling, you can get a deduction up to the losses. So if you had a lot of gambling losses, your deduction could be high, exceeding the standard, lowering your taxable income, lowering how much tax you should pay. But it lowers it. It's a discount. It's not a 1-for-1. It's not, it's like one of those, it's like, think of it as store credit. You could only use it up to the benefit of what the IRS says it's a benefit. Not necessarily a 1 minus 1 is 0. I don't pay any taxes on it. Clients get upset with me all the time. They're like, "Well, Joe, yeah, I won 10 grand, but I probably spent like 20 grand at the casino." Well, let's stop talking about the casino, because the new wave has been sports betting. And technology And apps and our cell phones have made sports betting even easier. I grew up in Yonkers, New York, where we used to have a racetrack. So you wanted to bet on horses, you had to go to the physical track back in the day to bet on horses. Now, you do it in the comfort of your own home on your cell phone. But you guys have a problem, and you guys need to start thinking because these applications are asking you for your social security number. Why? Because if you win big, you get a W 2G. Now it's taxable income. What's the change? It used to be 100% of the write off for the losses. So you won 10 grand, but you spent 20, you can itemize deduct 10 grand. Now, if you won 10 grand and you gambled more than the winnings of 10 grand, you're allowed a 90% itemized deduction. So you lose 10% off the top. So your deduction gets lowered. So that's a big change that OB3 did. It's what we've been calling it behind the scenes. Um, so you have to keep that in mind that if you had any gambling gains in 2025, we're going to see this change come in. And there's nothing we'll be able to do about it. Now, this gambling losses goes on the same form that my SALT goes on, the state and local income taxes. Schedule A, itemized deductions. Good news. SALT has now been increased, and it's only for these next 4 years, to $40,000. So, if I pay $25,000 of property taxes, and at work, I pay the city of Yonkers local income tax, I pay New York State taxes on my salary of 100 grand, my write-off is not going to be limited to the first 10,000 anymore. It's going to be limited to the first 40,000 on the federal level. New York has always allowed us to do 100%, but on the federal level, we're going to be now allowed up to 40. This is going to help a lot of my property owners, a lot of my people that work in NYC or Yonkers and pay high New York State income taxes itemize again, lower their taxable income again. So it's a lot of good news for teachers, police officers, firefighters, anyone that's earning six figures and above that's working in a locality that taxes you. So we're talking 5 boroughs and the city of Yonkers in New York State alone. So this is good stuff. This is good stuff for blue states, to be honest with you, because normally we're the ones that see more of it. So I'm very excited for that. What are the things you want to remember with the SALT though? It is going to be tapered off based on the income. So if you are a little on the higher end of an earner, you might start seeing some limitations. Again, this is something that your tax pro should break down for you. And if they can, it's time to get a new tax pro. But it's one of those things that I want you guys to keep an eye out. So my property owners, especially, we're going to be seeing a lot better results. The last thing I want to talk to you guys about was children and taxes. So this is actually something that I saw. I mentioned earlier. I couldn't help myself that we're only getting an additional $200 in the child tax credit. But what I am excited about is that they finally gave us an increase to the dependent care credit. My daughter is 5 and finally in public school. Yes, as bougie as you think I am, she went to public school. I just told you my property taxes were $25,000 a year. So no, she's not going to private school. I got a letter saying that she's not allowed to get free lunch, but fine. But then the governor, whatever her name is, said that we can't discriminate about income, so she is getting free lunch. I don't know, but they still wanted to deny me on paper. I don't know. Anyway, before public school, my husband and I were paying Bright Horizons. Love you guys down, but you guys were expensive as hell. $18.88 a month for preschool, for childcare. Now, preschool's a choice. It's not a requirement of the government. But if I paid any aftercare or before care because we were both working, the credit for us paying for childcare was a $600 credit a year, assuming that my income met that meant that only just to get $600 in a tax credit. During COVID, it was actually up to $4,000, which was amazing. That year, my clients that did pay a lot in childcare was actually, you know, benefiting a lot, but it was just a COVID thing. It went away immediately after. But now we're getting a little bit more, as high as like $3,100, I believe. It's based on a calculation. So the actual math, again, I'm not going to get into that with you because that's my job. The actual math has changed. So now allowing more of the expense to increase the credit. Um, in some cases, we're going to see it double. You know, parents are going to probably see anywhere between $1,200 to $1,500 in a credit, where before it was just $600 per child, and it was capped at the first two kids. And kids are ghetto. I'm not having kids anymore, but for those of you that have four, five, six, seven, there's going to be limitations on that. But at the end of the day, this is something that is big. It's not starting until 2026, which means we're not going to see it in the 2025 tax return. We're going to see it in the 2026 tax return. So keep that in mind. And lastly, one of the things that this bill, I'm going to end with this because I think it's hilarious, um, brought to our attention was that we now have what's called Trump accounts. You can open a Trump account for your child. And if you had a baby in 2025, best friend had twins just a couple months ago, you get the government will give you $1,000 starting in that Trump account for your child. Now, there's a bunch of contribution rules regarding it. It basically it's a savings account that's like the government. I like to look at it as U.S. savings bonds. I remember I used to get annoyed when I was a kid, and then my mom's friend would give me a savings bond of $50, but it's like I can't take this to GameStop, so what the hell am I doing with a paper that says $50? But when I was 18, I cashed those in and I used that money for my car. So one of the things that um, I'm comparing it to is like the modern day savings bond, right? Savings bonds are basically dying at this point. So the government's trying to put something out there similar to what the college saving funds do. This is not really a tax related topic, but the fact that if you have a child in 2025 and they were born in the United States from parents that were residents slash citizens of the United States, let's not forget the immigration clause, then you can go ahead and tap in. You can opt out, but you can tap in into starting this savings account for your child. You're allowed to contribute up to $5,000 a year, and I believe there's more stuff coming out with the Trump accounts. They're still in its phase of where they're trying to, you know, it's going to be run by banks. Okay, financial institutions are going to be involved, so it's one of those things. I thought it was interesting to bring up just because of the whole $1,000 per child thing. It's again, it's only starting now. If your child's already born, you can still participate. You're just not going to get the contribution of the United States. But to me, those are the most highlighted points that kind of stood out for me when it came to OB3, the One Big Beautiful Sexier Than Ever Act of 2025. And I hope you guys take some of this and research it and read into it so you understand and you're prepared, because again, tax planning is something you do now. I can't tax plan for you when you come to see me to do your 2025 taxes in 2026. So this is the time to take this information and make financial decisions, saying, maybe I should sit down with someone that knows about what's going on with these laws and can say, well, if I qualify, maybe I should buy a new car because I'm going to get the $10,000 deduction above the line. If you're an educator from K through 12, maybe you should say, wait, let me start going back to my credit card statements and seeing all the money I spent so far. It's September. The school year just started. I'm sure a lot of you spend a lot of money just getting your classrooms ready. I want my daughter's teacher not to see this on his tax return because he just asked me for a whole bunch of shit. Like a lot of stuff. And then when we went to go drop it off, there was like 20 packs of Lysol wipes. There was like he could have sold his own store. So my thing is that I don't want to see that motherfucker do any of that right off. He gets nothing. Because I feel like I just financed the whole year for him. But now you guys can think about it. You know what I mean? If you're in a certain situation, and maybe it's like, okay, maybe I should put more into the classroom out of my pocket because I know that I have investments and I have other tax situations that are happening. And at the end of the day, these are tax planning tools, and that's why you hire a tax professional and don't go to TurboTax, because you get advice and you strategize now. On that note, I do want to leave you guys with some quick updates. I've been working on a lot of exciting projects with a lot of my friends in different industries. So please look out for that. We're going to promise myself so much to bring you up to speed with what's going on with me. Um, Currently, I'm in some sort of investment opportunity that I am very excited to share. Big news very soon. This will affect my Yonkers clientele of J Squared. So I really want you guys to just pay attention, please, because we're going to be announcing a lot of big stuff really soon that I'm excited for. And on that note, thank you. And I hope that you guys learned something today.